Choosing the right business structure in California can be one of the most important decisions you make as an entrepreneur. The two most common options for small business owners are sole proprietorships and limited liability companies, or LLCs. Understanding the differences between these structures is crucial for protecting your assets and optimizing your tax situation. A sole proprietorship is simply a business with a single human owner, while an LLC is a company with one or more owners, called members. These structures differ significantly in terms of liability protection, formation requirements, costs, and operational flexibility. Liability protection represents the most significant difference between these business structures. As a sole proprietor, you and your business are considered the same legal entity. This means your personal assets, your home, savings, and other property are at risk if your business faces lawsuits or cannot pay its debts. An LLC, on the other hand, creates a legal separation between you and your business. If your LLC is sued or incurs debt, only the assets of the business are typically at risk. Your personal assets remain protected, except in cases of fraud or if you've personally guaranteed business debts. When it comes to costs, sole proprietorships are much less expensive to establish and maintain. You'll only need to pay for local business licenses, permits, and possibly a fictitious business name registration if you're not operating under your legal name. LLCs in California require more investment. You'll pay $70 to file articles of organization with the California Secretary of State. Additionally, California imposes an $800 minimum annual franchise tax on LLCs, regardless of whether the business generates income. Every 2 years, you'll also need to file a statement of information for $20. Both business structures offer pass-through taxation by default. This means business income passes through to your personal tax return, and you pay taxes at your individual income tax rate. However, LLCs have more flexibility in how they're taxed. They can elect to be taxed as S corporations or C corporations, which might provide tax advantages depending on your specific situation. Forming a sole proprietorship requires minimal paperwork. You simply start doing business, obtain any necessary licenses or permits, and file a DBA if needed. There's no state filing requirement to establish the business itself. Creating an LLC involves more steps. You must file articles of organization with the California Secretary of State, create an operating agreement, and comply with ongoing state requirements. While this process takes more time and effort, many business owners find the benefits worth the additional work. Sole proprietorships offer several advantages. They're easy to form, provide complete control over business decisions, involve minimal record keeping, and have no separate business tax returns. However, the unlimited personal liability represents a significant drawback. Additionally, sole proprietorships may struggle to secure funding and appear less credible to potential clients or partners. LLCs provide liability protection, enhanced business credibility, and greater flexibility in management structure and taxation. They also make it easier to bring in investors or additional owners. The downsides include higher formation and maintenance costs, more complex record-keeping requirements, and the annual $800 franchise tax in California. A sole proprietorship might be the right choice if you're running a low-risk business, testing a business concept before committing to a formal structure, or operating a short-term project. Freelancers, consultants, and small service providers often start as sole proprietors due to the simplicity and low costs. An LLC generally makes more sense when you have significant personal assets to protect, operate in an industry with higher liability risks, plan to grow your business substantially, or might need outside investment. Retail stores, food service businesses, and companies with employees often benefit from the LLC structure. Regardless of which structure you choose, both require compliance with federal and state tax laws. Both will pay income taxes on business profits. If you have employees, you'll need to handle payroll taxes and other employment-related requirements. LLCs face additional compliance obligations in California. They must file biennial statements of information, maintain proper business records, and pay the annual franchise tax. Failing to meet these requirements can result in penalties or even the administrative dissolution of your LLC. The decision between a sole proprietorship and LLC in California ultimately depends on your specific business goals, risk tolerance, and financial situation. While sole proprietorships offer simplicity and lower costs, LLCs provide liability protection and greater flexibility that many business owners find essential as their companies grow. Consider consulting with a business attorney or tax professional to determine which structure best suits your unique circumstances.